The US dollar is quietly losing purchasing power, and almost nobody is talking about it. Right now, US inflation is running at 4.2%, while the interest rate paid on dollar deposits is less than 3.75. Think about what that actually means. Even if your money earns interest, you are still losing purchasing power every single year. Your dollars are growing slower than prices. In real terms, you are getting poorer. This is called negative real interest rates, and historically, it's been one of the biggest warning signs for a weakening currency. If inflation continues to outpace interest rates, the US dollar faces ongoing depreciation in real purchasing power, and when the world's reserve currency starts losing value, the effects ripple across every market, from stocks and bonds to gold, Bitcoin and foreign exchange. In today's video, we are going to break down exactly why this is happening, what it means for the US economy, and how investors are positioning themselves before the rest of the market catches on. To understand why this matters, let's compare the US dollar with another major global currency, the British pound. The difference is striking. In the United States, inflation is running at 4.2%, while interest rates are only 3.75%. That means investors holding US dollars are experiencing negative real returns. Their money is losing purchasing power over time. The United Kingdom is in a much stronger position. There, the policy interest rate stands at 3.75, while inflation has eased to 2.8%. In other words, interest rates are above inflation, allowing savers to earn a positive real return after accounting for rising prices. This may seem like a small difference, but for global investors managing billions of dollars, it's a major factor. Capital tends to flow toward currencies that preserve purchasing power rather than erode it. When one currency offers positive real yields while another offers negative real yields, the stronger currency often becomes a more attractive destination for international capital, and that's one of the reasons why the British pound currently enjoys a more favorable macroeconomic backdrop than the US dollar. And it's not just the British pound. Take the Australian dollar as another example. Australia's benchmark interest rate currently stands at 4.35%, significantly higher than the 3.75% available in the United States. At the same time, Australia's inflation rate is around 4%, which is also lower than 4.2% inflation rate in the US. That means Australia offers both higher nominal interest rates and lower inflation than the United States. For global investors, that's an important combination. A currency that pays higher yields while experiencing lower inflation is generally more attractive than one offering lower yields alongside higher inflation. When multiple major economies begin offering better real returns than the United States, international capital has more incentive to diversify away from the US dollar, and if that trend continues, it could place additional downward pressure on the dollar over the long term. The message from the macroeconomic data is becoming increasingly clear. Compared with several other major currencies, the US dollar is no longer the obvious leader when it comes to preserving purchasing power. And the trend doesn't stop there. Even the euro, which has often been criticized for having relatively low interest rates, has delivered a strong inflation-adjusted position than the US dollar over the past year. Across many of the largest and wealthiest countries in the Eurozone, inflation has fallen below the European Central Bank's policy rate. In other words, interest rates have generally remained slightly above inflation, allowing the euro to generate positive real yields for savers and investors. That's sharp contrast with the United States, where inflation continues to outpace interest rates, resulting in negative real returns. This shift is important because international investors don't compare currencies in isolation. They compare where capital is threatened best. If the euro offers positive real returns while the US dollar delivers negative real returns, the euro becomes increasingly competitive as a store of value. And when that happens across several major currencies at the same time, it weakens one of the key advantages the US dollar has enjoyed for decades. For the first time in years, the dollar is no longer clearly outperforming its major global peers on real interest rates basis, and that's a development financial markets cannot afford to ignore. Now let's zoom out. Forget the headlines, forget the monthly inflation reports, forget what politicians and central banks are saying. Let's look at one simple question. What has the US dollar actually bought over the last 25 years? Because a currency's true value isn't measured by what government claims it's worth. It's measured by what it can actually purchase. And when we compare the dollar to two forms of money that have preserved wealth for thousands of years, gold and silver, the results are astonishing. At the beginning of the 2000s, 1 ounce of gold cost roughly $270. Today, that same ounce trades for well over $4,000. That's an increase of nearly 1,400%. But here's the key point. Gold didn't suddenly become 14 times more useful. It didn't become dramatically rarer overnight. It didn't suddenly develop new industrial applications that justify such an increase. What changed was the value of the currency used to price it. The US dollar steadily lost purchasing power. Gold simply exposed that decline. Think about it. 25 years ago, a few $100s could buy an ounce of gold. Today, it takes roughly $4,000 to buy the exact same ounce. The gold hasn't changed. The measuring stick has. And that measuring stick is the US dollar. The same pattern appears when we examine silver. Around the year 2000, silver traded for approximately $5 per ounce. Today it costs many times more. Silver has always been more volatile than gold, but over the long run it tells the same story. It takes far more US dollars to buy the same amount of precious metal than it did a generation ago. That isn't an accident. It's the natural consequence of a monetary system built on expanding money supply, persistent inflation, and ever-growing government debt. Every time new dollars are created, every time deficits are financed through additional borrowing, and every time the money supply expands faster than the supply of real assets, each individual dollar represents a slightly smaller claim on wealth. You don't notice this in a single month. You barely notice it a single year. But over decades, the effect becomes impossible to ignore. This is why many professional investors don't measure wealth solely in dollars. Instead, they ask questions like, how many ounces of gold does my portfolio buy today? Or, how much silver can my saving purchase? Those questions remove the illusion created by constantly depreciating fiat currencies. Unlike paper money, precious metals cannot be created with a keystroke. Gold production increases only slowly each year, and silver supply is also naturally constrained. That scarcity is exactly why these metals have preserved purchasing power across centuries. Currencies have come and gone. Empires have risen and fallen. Monetary systems have changed countless times. Yet, an ounce of gold has remained an ounce of gold. This is also why central banks themselves continue to accumulate gold reserves. If fiat currencies were the ultimate long-term store of value, central banks would have little reason to hold thousands of tons of precious metals. Yet they continue buying. They understand something many retail investors overlook. Gold isn't just another commodity, it's a monetary asset. And throughout history, whenever confidence in paper currencies weakens, investors tend to seek assets that cannot be printed. That's exactly what we have witnessed over the past 25 years. The spectacular rise in gold and silver prices is not simply a story of precious metals becoming more valuable. It's also the story of the US dollar becoming progressively less valuable when measured against scarce tangible asset. From this perspective, the chart isn't just a bull market in gold. It's a long-term report card on the purchasing power of the US dollar. And if inflation continues to exceed interest rates while debt levels keep climbing and monetary expansion remains a long-term policy tool, the dollar's decline against hard assets may still have much further to go.